SaaS Backwards is sponsored by Austin Lawrence Group, specializing in demand gen for SaaS. It sure is noisy. I deleted 100 emails from vendors just this morning. Your buyer has gotten better at ignoring you, and you're gonna need a big idea if you want to cut through all that clutter. Austin Lawrence is just the right agency to help you find it. So if your campaigns are falling on deaf eyeballs, let's talk. Visit austinlawrence.com today and let's build something bigger.
Welcome to the SaaS Backwards podcast, where we reverse engineer the success of fast-growing SaaS firms and explore strategies CMOs and CEOs are using to drive their businesses forward.
Welcome to SaaS Backwards, a podcast that helps SaaS CMOs and CEOs to accelerate growth and enhance profitability. Our guest today is Ari Kahn, President and CEO at Bridgline Digital, a company with SaaS solutions that transform how brands interact with their customers, bridging the gaps between marketing, content, commerce, social, and insights. Hey, Ari, welcome to the podcast.
Thank you, Ken. Great to be here.
Great to have you. And before we dig in, could you tell us a little bit more about yourself and your company, Bridgline Digital?
Sure. My background is in software engineering. I have a PhD in artificial intelligence and have been really an entrepreneur for all of my life. My first company, FatWire, was founded in '96. We were one of the first companies in the marketing technology space. And Bridgline, where I'm the CEO today, is also in the marketing technology space. At the end of the day, we provide software that helps companies increase their online revenue by growing traffic to their site, by helping to convert that traffic into buyers, and by increasing the average order size of each of those buyers.
Sounds like a mission we can all get behind as online marketers.
Agreed. You know, there's a saying, marketers have two problems: revenue and everything else.
Yeah, well said. Hey, in this episode, we're going to focus on, I think, a lot around M&A as a way for an entrepreneur to grow a business, and also perhaps what it's like on the other end, like if you're looking to sell. And I don't know if we could quite call it a masterclass, but I think you certainly could help us run a masterclass on M&A. And I thought it would be fun. You said you have a great story to tell about the first acquisition you ever did. And you said it was a little unusual. Maybe you should tell us about that acquisition and what made it so crazy.
Of course, it was crazy. I've done several acquisitions, both on the buy side and on the sell side. But the first time that I did an acquisition was during the dot-com crash of 2000. And with my first company, we raised money, $10 million, approximately right before the dot-com bubble burst in like January of 2000, 2 months before everything blew up. So we're sitting there with all of this money. We don't know how to spend it, and companies are going down fast. And the first company that we took a look at had a $1.2 billion market cap, could not readjust for the new reality, which is that you had to be profitable. And we went into bankruptcy court and bought that company for $10 million. And here's how it went down. The judge broke the company into 7 pieces. One of the pieces was just a patent all by itself for the online shopping cart. That's how things were back then. You could have patents for crazy stuff. And the company that we bought, sitting there in court, you've got 7 other private equity firms or VCs. And the judge said, all right, you know what? We've got a stalking horse that's going to pay $42 million for everything. You guys have to add up all of your bids to be $1 million times the number of bidders, plus the $42 million that the stalker is going to pay. And we went, no one knew each other, back and forth for 2 days, all night. Great, we'd get together. Okay, we're up to $42 million. Stalker would show up and say, hey, now I'm at 43. Okay, we got to get 43. And at the end of the day, the only way we closed the deal was that I did a contract on a yellow notebook pad in front of the cameras to someone I never met before, and said, hey, why don't you just buy, you kick in the $10 million that I'm supposed to pay. You guys buy that, and it'll be one less bidder. We reduced our what was called the restructuring fee by $1 million because there's one less bidder, and that's how we get over the hump. And that's how crazy things were back then. For $10 million by a $1.2 billion company, and you could do a notebook pad for a $10 million agreement to buy something for you so you could buy it the next day and save $1 million.
Wow. Well, certainly the rubble of the bust was opportunity for people if they could find the gems in there.
Yeah. The craziest thing about that is that then the next day after I closed and got the $10 million, we sold half of that company back to the founder of the original $1.2 billion thing for $4 million. So net, we only paid $6 million for what we got.
That's awesome. So you got to be willing to make a deal, right? And I think it might be worth talking about how, you're focused at Bridgeline on building a company. I was really impressed with the discussion we had in prep for our interview today about how you are building what I guess might have been called a roll-up of companies in a specific domain, but you have a specific method for how you bring them into the fold and get them going quickly within your revenue machine. And I'd love you to just spend some time on how you approach that process. So I think it's different and worthy.
Well, it is different, and it really is based off of some of the peculiarities of the SaaS industry itself. So in the SaaS industry, you have a problem. And the problem is that your customer acquisition cost is often not recouped for several months, often an entire year after you win that customer. So imagine that it costs you $10,000 in sales and marketing and commissions to win a new customer. But the customer is going to sign a 3-year contract for $1,000 a month. Well, that's great. I only spent $10,000 to get $1,000 a month for 36 months, right? That's $36,000. But I had to pay the $10,000 before I won the customer in marketing, and I'm only collecting the money potentially on a monthly basis, and until month 10, I am in the red, so to speak. Well, this is one of the reasons why M&A is so important in the SaaS industry, because on the sell side, companies that have great ideas and are growing, they run into this cash flow trough where they need to inject capital just to support their own success, because every sale they make digs a deeper and deeper negative hole for the first, in this example, 10 months. And therefore, they have to make a decision as to whether they're going to slow down growth, raise capital, or sell the business to someone that can afford that cash flow trough. And fundamentally, inside of the SaaS industry, that cash flow trough fuels M&A. Now, we take a special approach with that challenge directly in mind, which is that when you buy a company, you're not just buying the technology. You're not just buying the employees. You're also buying the customer base. And the marketing cost associated with selling a product to an existing customer base is much lower than selling a product to new logos, new companies that you don't have a relationship with. So in the SaaS space, especially, you buy companies so that you can reduce that cash flow trough by now having an even bigger customer base that you can sell your products into. So we find companies that have great ideas, but are challenged from a funding perspective to grow with this headwind of the cash flow trough. And then we help that product and that engineering team grow by rolling them into Bridgeline and selling that product into our customer base, which is relatively inexpensive, and then also selling our products into its customer base. That technique of buying companies for multiple reasons is absolutely critical. You need to have a secret sauce. You need to have an unfair advantage in the M&A world for the acquisition to make sense. 90% of acquisitions fail for the buyer. What does that mean to fail? It means that your multiple in terms of your own valuation is lower than the multiple after you do the acquisition. Originally, your company is trading at 3 times revenue, and now you just bought another $5 million in revenue, but the new valuation after a year is even lower. That happens 9 times out of 10 because you don't have a secret sauce on the acquisition. And being able to leverage the customer base in addition to the product itself is a huge way to make sure that your acquisition will be successful.
So I think that's a great explanation, and heard a lot. So that's really awesome. And that is realized not just in this strategy, but in how you staff the teams, right? So you have different sales teams for different purpose. It might be worth talking about that. And as well, how you focused on one kind of specific area and how that software is presented. So I think if you could talk about those two things, the people and the experience kind of as hand in hand.
Sure. Well, you have very different sales cycles and skill sets for selling into different prospective customer bases. And the most glaring difference between customer bases is selling into people you don't know and selling into people you do know. If you're selling into companies you don't know, well, first you have to make them aware of you. That's marketing spend. Then you have to have almost a short-term mentality where it's like, okay, great, let's find out whether we're going to do business together or not. And if no, okay, no harm, no foul, goodbye. We're never going to see each other again anyways. As opposed to if you're selling into your existing customer base, you've got, first of all, no marketing spend. You're already talking to them all the time anyways. But if it's not the right fit, you can't just turn your back and say, fine, you've got a long-term relationship that needs to be managed, and you got to be able to manage it appropriately. So you have very different personalities there. At Bridgeline, we have two separate teams. We've got hunters and farmers. Hunters, they go out and they shoot the new logo. No problem if they miss, they'll just go shoot at something else. And we've got farmers. They cultivate existing customers, sell new products into those existing customers, and are really there for long term. It's a very different psychology. People's career path rarely goes from being a farmer to a hunter or vice versa. They might be in the wrong seat and they move from one team to the other. But because it's a fundamental psychology, it's rarely a career path move that actually makes sense. We do acquisitions, and the acquisitions have to work for both our hunting team and for our farming team. We buy a company, the product's got to be sellable. So our hunters need to be able to take that product and win new customers. The product also has to be desirable to our current customer base so that our farmers can say, hey, I got something great for you to take a look at. Let's see if it can help you.
So that almost makes Bridgeline like an evergreen, interesting partner for your customers, right? Because you're always looking for new solutions to bring them.
You know what? That's really important in the SaaS space, especially. In the SaaS world, it's all about your LTV, your lifetime value of each customer. Again, going back to that SaaS cash flow trough, if you don't have a long-term value, you never pay those original customer acquisition costs. You have to have a long-term relationship. You've got to be able to manage those customers, and you have to keep bringing new value, especially in the marketing technology space. Stop showing up with something new that's going to add value to the customer. Sooner or later, they're just going to try some other technology and move on to another customer. And that customer acquisition cost is a huge hurdle. So you need to make sure that you've got a low churn rate, that your customers love you, and that you're always bringing new value to them.
It's really interesting. I didn't ever think of marketing tech as being something of a fashion business. And, I think of the agency business that way, that we always have to bring the new ideas and show new technology for marketing. And so it's kind of fascinating to hear that on the software side of things, we need to be pushing the leading edge and making sure that we're bringing the innovation so someone else doesn't, right?
And it's not a one-man show. On the software side, you have to create strategic partnerships that can bring different value to your customers. For example, agencies is a big partner focus for us, but agencies fundamentally have very different characteristics than a software company from a financial and structural perspective within the business itself, things that just become incompatible and difficult for one company to do, both software and agency work. So to provide greater value, we partner with agencies so that when it's time to look at strategic changes to an e-commerce site, for go-to-market strategies and so forth, that we don't just roll in with a bunch of techies that are going to geek out on the latest JavaScript blog, but instead people that really understand markets, digital typically, it can add that value. And in the long run, as long as we're making that customer successful, Bridgeline is rewarded.
Makes a lot of sense. Now, when we talked last, we discussed what the user experience looks like. And I thought it was interesting that you've basically said, hey, we don't need to make one sheet of glass necessarily to be successful. And I think if I understood it or interpreted it correctly, the idea was to get the solution in front of your customer base as soon as possible, and over time work to homogenize the offer. Did I understand that correctly?
You did. I would describe it a little bit differently than that, but you certainly did. You know, the world has evolved today to a point, at least the marketing technology world has evolved to a point where it's no longer about trying to solve all of your problems all at once. And there is no correct solution or technology to growth. It's a huge number of small pieces that might work for you, they might not, but they work for someone else, or they might work for you today, but tomorrow or with a different customer don't work. And in this case, what Bridgeline does is that we provide a suite of products that allow you to, for instance, increase traffic to your site in one of a half a dozen ways, or to increase the conversion of that traffic into a buyer in another dozen ways. And you can select the one that may make sense for you today and compare it with, for instance, A/B testing tools, other software, and make an intelligent choice as to whether you're going to continue using this or not. This allows Bridgeline to have multiple entree points to win new customers, to expand within a customer and don't make them buy everything all at once. Just get what you need right now, try it out, and add to it later. And to more quickly, incrementally create new products that some customers want and other customers don't want. Gartner has spoken about microservices and breaking products into microservices where you can turn on different features. I think that you even go a level farther than that, where you decompose your product into a large number of micro products, of smaller products, where people can pick and choose a la carte.
So I think that's also, it's a little counter trend, right? A lot of folks in the software business are trying to make this product managed single experience thing. And I think what you're saying here is, let's look at the business value that we can drive for you with a set of solutions that might vary over time.
Exactly. And deconstruct that value. It's easier to just try to throw everything in one bucket and see if someone will buy it, but it's not the right thing to do today. What you need to do is you need to fundamentally understand what the different challenges are that your audience might encounter, break it down into bite-sized pieces, come up with a nice, clean, and crisp solution for each one of those pieces, or multiple solutions even, and then let them make the decision of what they want to do when.
That's really awesome. And I think, again, a lot of SaaS founders would benefit from having that different kind of point of view, different lens to view their product through. I think it's really cool. Can we talk a little bit about what an acquisition process looks like, what the math is? I mean, you touched on it a little bit, but sort of like, what's the logic behind a good deal as an acquirer?
Okay, great. Well, here, I'm going to step back for a second. I want to share a couple of terms, because it'd be difficult for me to talk about this, that are created in such a way to be polite, but can be confusing. So I'm going to speak about targets, polite word for a company that you want to buy. We'll talk about synergies. Synergies are all the people you're going to fire when you do the acquisition. We'll talk about organic growth and inorganic growth. That's either buying companies or just doing a great job at sales and marketing and growing by yourself, and other terms. But the first step is, are you going to be buying or selling a company? A lot of times using a bank or an investment banker to help you in this process. If you're on the buy side, if you're buying a company, how much are you going to pay for that company? Today, the rule of thumb is generally to use what are called multiples. And in the SaaS world, you're usually talking about a multiple of revenue. as the valuation for a company. The alternative is the multiple of profit, which is usually measured as adjusted EBITDA. But let's focus on multiples of revenue. A services company, professional services where you have humans billing out time, are often being sold at 1x revenue, right? So the enterprise value, which is the value of the company minus the what's called working capital, the cash and accounts receivable and accounts payable, you need to strip that out so you can just have the enterprise value. That's 1x revenue. In the SaaS world, because now you just have a computer, not a human being performing the services, and your gross margin is generally in the 75% range as opposed to professional services, which is more like 40%. A good rule of thumb would be 3x revenue as a valuation. Might be as low as 2x. Sometimes you get ones that can be 5x revenue or even higher for unusual reasons, but 3x revenue is a good general number to look for. And that's influenced by churn rate, contract length, and gross margin.
So that's a little lower than I've heard. Is that a revised number for current circumstance, or is that
actually
the savvy operators set of numbers?
Okay, great point. Great point, Ken. So first of all, there's something called survivorship bias. What that means is that people only talk about the exciting deals that are worth talking about and that actually happen and survive. So no one talks about the deals that are just mediocre and you don't hear about them and people get excited and talk about the 5x. The reality, like Bridgeline, we generally only pay 2x revenue when we're doing an acquisition, maybe as high as 3x revenue. And none of that stuff will make it to the news. And if it did, none of those stories would survive long enough for many people to read them because it's boring. When Shopify pays 8x revenue, it's all over Yahoo Finance and so on and so forth. And people talk about that. You know, firstly, if someone wants to sell their company, you're going to need a good banker, someone that you can meet with regularly, who is going to tell you two things straight up. One, you're probably not going to be able to sell your company. Most processes, that's the lingo for selling a company, fail. Fine. Now I know that. Be ready for it. And second of all, don't be heartbroken if you have a 2x revenue offer, 1.5x revenue offer, 3x revenue offer is something that you a lot of times need to jump on. If you have very high growth, then you could see a higher offer. Your multiple of adjusted EBITDA, if you're very profitable, on the low end is probably 6x adjusted EBITDA. On the high end, it's probably 12x, double that, 12x adjusted EBITDA, which would be similar to on the low end, 2x revenue, on the high end, 4x revenue. Your adjusted EBITDA could impact, but in the software world, adjusted EBITDA, again, is typically not the focus. It's going to be on growth. When you're selling the company also, by the way, a lot of deals blow up because the seller doesn't have their financials in the right form to sell the company. And although that can be fixed at deal time when you're working through your acquisition agreement, it can create misunderstandings where people get emotionally tied to one particular purchase price and things blow up. And in particular, you've got two things that I've seen blow up deals at the last minute, multiple times, in fact. The first one is the working capital adjustment. So when you're buying a company or selling a company, it's generally done on what's called a cash-free, debt-free basis, right? I mean, a company might be worth $10 million, but if it's got $2 million in debt, then it should be worth $8 million because the guy's buying something he's going to have to pay $2 million to get rid of. The working capital has a number of things like accounts receivable, accounts payable, cash on the balance sheet that can blow it up. And if that's not clear to the buyer and to the seller on day one, and they get a number stuck in their head and then have to adjust it for the working capital, well, now you've got an emotional investment in a particular number that was wrong, and it blows up deals. The second thing that blows up deals is deferred revenue. So deferred revenue, if a company pays you whatever, $10,000 or $12,000 for a 12-month software subscription, and now each month you're going to provide this service, that $12,000 doesn't really belong to the company yet because it hasn't provided the services yet. After 1 month, $1,000 of it belongs to the company. The other $11,000 is really not earned. So if you're the buyer and you buy a company and the company just signed a contract for $12,000 for 12 months and the money's gone, the buyer assumed it was his, or the seller assumed it was his money and gave it out for salary or whatever. All of a sudden, the buyer of that company is going to say, well, I need to consider that to be a $12,000 deficit inside of the working capital. And I'm going to pay you $12,000 less for this company because I got to provide the services for the next 12 months. And it costs me money to run those servers and have the humans that manage them and so on and so forth. So that's something else that people really need to make sure they've got a good banker that helps them understand and fix their financials for working capital, in particular deferred revenue, and that you don't have these sort of issues show up at the last minute that can create an emotional problem that kills the deal.
So, we just scratched the surface here. I almost feel like there should be a series of webinars or something for software CEOs to be on either side of a deal, to get ready to be on either side of a deal. And if you're going to be buying companies, to really elaborate a vision for what that's going to look like before you go shopping.
Mm-hmm.
So, I don't know if we're going to get to do it together. Maybe we will, but just
Maybe.
throwing it out there, I think it would be great stuff. I don't think there's enough of that kind of education for CEOs. And so many of them, they're not SaaS experts when they start out. So I think this is high value. Can you talk to me just a little bit, if we step back into Bridgeline a little bit? One of the things you mentioned when we were talking about your company and the SaaS world in particular is that you say sometimes it's very difficult to understand the impact of major investments in marketing to the enterprise value, to the revenue, and ultimately the value of the company. And you're on the marketing automation business. So clearly you have a vested interest in people being able to identify return on investment from marketing into revenue. But from your experience, what's the reason that it's difficult? And what are you doing at Bridgeline for yourselves to better understand the investment in marketing and how it's paying out for you?
Right. The SaaS industry has a different set of challenges than traditional businesses do because of the nature of a subscription and the long-term value and the cost of winning a new subscription. So first of all, there's a rule of thumb that I think works super well. And it is the CAC to LTV ratio. CAC meaning customer acquisition cost, LTV meaning the lifetime value of the customer that was acquired. And that ratio generally should be 3 specifically. If it's too high, if you've got a 4 or a 5 or a 6, then you're getting so much lifetime value for your customer acquisition cost that you should spend more money on marketing and grow and pull it back down to 3 and just slingshot your growth. Sometimes you can't do that because you don't have enough cash because that cash flow trough again, but that's what you should do. If it's too low, if your lifetime value is $10,000 and your customer acquisition cost is $7,000 and you've only got a 1.3 ratio, well, then that's even more difficult because maybe there's no market, maybe your marketing team is not very efficient, maybe your competitors are too strong, but you've got a significant issue. But either way, if you're too far off of 3, you need to really reflect upon that. In order to measure that, you need to, truly know which campaigns are attributable to which customer wins, how much those campaigns cost. You need to know what the sales cycle is. If I spend $10,000 this month, I can't look at the lifetime value of customers I won this month because my sales cycle is 10 months. So I need to, look forward and decide what it is out then. And if I don't have a tracking system that is accumulating all of the opportunities created by a particular campaign over time and seeing what the eventual win rate is of each of those, then I'll never be able to connect the dots, repeat the campaigns that worked, and stop doing the campaigns that don't work. And because the whole cash model in the SaaS industry is so challenging as opposed to just selling a product where you get all the money all at once, that attribution is even more important. And a misstep that could take a long time and dig a big cash hole can put a company out of business.
Wow. So this has been a really fascinating conversation. Really grateful to you, but it's only a 30-minute podcast, and yet there's hours more to talk about. So I'm sure there's going to be someone out there who's interested in picking your brain a little bit on maybe an acquisition they're thinking about, or maybe they have a company to sell. How would that person get a hold of you, Ari?
Oh, well, you're welcome to reach out to me. The best way to do it is through our investor relations email address, which is investorrelations@bridgeline.com. And our M&A team would then see those types of requests. And in general, if you're interested in processes and want to sell or buy a company, the number one thing is to make sure that you have a good investment banker. And I'm not going to plug a particular banker here on this podcast, but on an individual basis, I've got ones that have worked really well for me on different sized companies on the buy side and the sell side. And I'd be happy to speak with anyone in that regard.
That's great. I just think that this is a whole area of education of the SaaS CEO that is not apparent when you're on your way into the business. So really appreciate you sharing your insights with us today. Folks want to reach me, easy to find me on LinkedIn/in/Ken Lempit or my website at austinlawrence.com. Ari Kahn, thank you so much for being a guest on SaaS Backwards, and I hope we'll have a chance to do something along this line, maybe a little deeper dive somewhere in the future. Thanks so much.
Thank you, Ken.
Thanks for listening to the SaaS Backwards podcast, brought to you by Austin Lawrence Group. We're a growth marketing agency that helps SaaS firms reduce churn, accelerate sales, and generate demand. Learn more about us at www.austinlawrence.com. You can email Ken Lempit at kl@austinlawrence.com about any SaaS marketing or customer retention subject. We hope you'll subscribe, and thanks again for listening.